How are you, Maliha? Good morning.
I'm good, thank you. I've just been off the desk for the last few weeks, so nice to be back. Although it's really dark, and I was in Dubai a few weeks ago, so I'm not used to the color difference of the weather.
Yeah,
It takes a bit of time to get used to.
yeah, the weather is terrible in UK now.
Good morning, everybody, and welcome to the Daily Energy Markets podcast. It is Tuesday, February the 6th, where the weather is beautiful in Dubai, a nice cool 22 degrees. So we'll take that for as long as it lasts. Unfortunately, never lasts too long. Oil prices, however, are a tepid $78 a barrel or thereabouts. The trading at the moment ultimately more or less where they were at the beginning of January, a month ago. We had that climb up to sort of $84 a barrel from 76 or 75, 76, and then back down again with oil prices. Brent looking today at least at trading at the moment in and around 78.20, and WTI a few dollars back from that. Let's kick off this morning with Ali Al-Rayami, a consultant and former director general of marketing at the Ministry of Energy and Minerals in Oman. Ali, your thoughts in a month in which there's a lot been happening in the big world and in our regional world. Oil prices have reacted a little bit, but have essentially come back down into the 70s. Your thoughts on the sort of balance of this market when the geopolitical noise goes off stage? This market looks like it wants to come down. Your thoughts?
Well, thank you very much, Sean, and good morning. Actually, since the beginning of this year, we have seen some, prices going up and down based on situations, political situations, and also economic positions. But overall, I think the market is not very stable at the moment, and this was expected since the end of last year. And the beginning of this year, of course, we have some few refineries in Asia. They will soon go to shutdowns for maintenance and so on. And also the economy, the world economy, and also the Chinese growth is not there yet. I mean, there is still, until today, we see some fears on how much that we can depend on growth in China. Let alone Europe also is not doing very well. The only economy, the world economy, is doing better than others is USA, but still there is still the inflation and also is there, and also the fears on interest rates that it is not really going to happen that according to what has been expected. So all of this, I think it was a fair price, taking this all in consideration. We thought that with attacks on from Al-Houthis and also some uncertainties on the Red Sea, we will see some a jump on the prices, but it didn't happen. For maybe could be the reason is that the Al-Houthis they are not attacking or targeting the oil tankers. They are just now until at least recently we haven't seen any attacks, big attacks on oil tankers. All what they did is just attacks on ships that goes and destination is Eilat and also in Palestine. So those could be the reasons. But again, I mean, the interference of UK and also USA on Red Sea, we also thought that this will escalate the situation, but we haven't seen all of that, and we still until today almost like 1 month and a plus we haven't seen any jumps, high jumps. And this shows you that the fundamentals, the market fundamentals, the real fundamentals are not really supporting the price to go up.
Malia Bengali, founder, MB Commodity Corner. Malia, the oil markets seem to be a little bit like the US economy in some ways, where the headlines seem to be very positive. The jobs numbers last Friday, the GDP numbers for Q4 over 3%. Inflation's coming down. That's happy, soft landing on a nice soft cushion. And yet the general sentiment in the US seems to be that your average person is not happy with the economy. Same thing on the oil markets. We just had the IMF revise upwards global economic growth, US economy, biggest oil consumer in the world, doing great. And yet the oil market doesn't seem to be happy. A little bit like the US employee, got a job but not happy. What's going on?
You're absolutely right. I think we have to consider US and China separately. The US market, as Ali pointed out, there are only a handful of stocks that are doing well. The rest of the economy is actually, the stocks are not doing well. We saw them report. Now, oil we spoke about 2 months ago is that, oil, there never was any shortage. You've seen oil prices correct, but we have a seasonal trade where during winter, you get some tightness in distillate demand, and that sort of helps the oil prices hold up. We feel OPEC Plus had over tightened to Q1, so oil prices held really well. But as the oil price rallied, China is imploding. We saw the markets yesterday were down. They're down 20% in 10 days. I think that's dragging all commodities down because you've seen copper down, aluminum, nickel, iron ore. So anything China-based focus is actually underperforming. Having said that, oil does have a lot of sort of cyclical factors supporting it in terms of distillate demand, and gasoline is not too bad. But it is really playing a seasonal game right now. If the world economy is going through recession, which we see a massive slowdown, oil will not be immune to that slowdown. I mean, it will have to correct as well. So the question is, does it happen right now or probably after winter? So it's faring the best, but I think this sell-off that we saw recently has been overdone on back of the dollar rally. The Federal Powell came out and said that he's not going to be looking to cut rates anytime soon. And I think the market's sort of, hoping about 7 to 8.
Is that a good story or a bad story from demand point of view? I mean, in the sense that the economy is doing so well, I don't need to change rates.
That's absolutely right. But when you look at the actual demand supply, commodity supply is very strong. So the economy, you have to look at every commodity from a demand supply point of view. China has been actually pulling in pretty good barrels in December and Jan, but there is no shortage of oil. We still have about 5 to 6 million barrels per day out of the market, right? So you see about only manufacturing, onshoring, US manufacturing is doing well because that's where all the Inflation Reduction Act and government Biden fiscal spend is helping. But there are parts of the economy that are not doing well. And I think there's a lag effect as well because we've seen 12 to 15 months of a rate tightening. The Fed's in a bit of a checkmate right now because we're going to see some horrendous payroll numbers. We've seen every company shed about 10 to 20% of their workforce, yet the employment numbers show a gain of 300,000. We think there's a big disconnect, and we're going to see probably a nasty print in Feb, March. So I think it's a matter of when, not if, and there'll be a disconnect because prices paid are higher. So can the Fed really cut right now? And we think it's in a very precarious situation. But the demand from the commodity side in China has been very weak, for sure.
Saleh Yilmaz, senior energy equity analyst at Bloomberg Intelligence. Whatever's happening in the markets, the oil companies seem to be very happy indeed, making huge amounts of money. And we just saw results in for the fourth quarter, generally, massively impressive. 2023, we saw Exxon, Shell, and Chevron, three biggest IOCs, return $80 billion to shareholders. Is this party going to keep on going? What's your outlook for this to continue?
Yeah, I think so. So we had three of the majors reports so far, and BP is reporting actually right after this call. And as you say, they've reported pretty solid results. I mean, generally, I think we're looking at them bringing cost optimization, more projects, more shareholder returns. These are the things that the shareholders would call a party. And usually you would have this in the booming times. And this is not necessarily a booming time per se, because these results came despite lower oil and gas prices in 2023, weaker refining margins, and less volatility, which is generally good for...
on the year, obviously, the numbers were massive, but quarter to quarter, fourth quarter 23 versus fourth quarter 22, ExxonMobil's fourth quarter earnings were down 40%.
Yeah, but I think what the shareholders have been looking at is, was it a beat versus consensus? And it was in all three cases. they maintained buyback pace. And I mean, you're right. Like 2022 was an extraordinary year. 2023 wasn't, but buybacks are almost nearly at the same level. We had dividend bumps. I think for Shell it was about 4% dividend bump. For Chevron it was 8%. I mean, with Exxon there was a production growth from both Permian and Guyana, and pretty strong output from Chevron as well. So I think a lot of the key metrics that investors must have been looking at were positive in all three cases. I mean, let's see how BP reports as well, but so far, I think pretty strong. I mean, obviously, this year, I think shareholders will be looking at things like, like they need to keep the capital discipline. I think Exxon has started talking about higher spending. I mean, we've seen this before, and I think investors will be looking at how efficiently that capital is being deployed. But generally, the commitment to shareholder returns appears to be there still. And I think we're going to see another year of very kind of continued focus on return on capital employed, which is what shareholders are prioritizing.
And that would probably mean less money in the ground for new capacity, right?
You would think so, and I think beyond the international oil majors, as I'm sure you may have discussed on this call, what Aramco, a national oil company, also did last year with its halting of its planned oil production capacity expansion is showing that, I think dividends. I mean, in the case of Aramco, there are no buybacks, but dividends seem to be preferred, and for various other reasons in the case of Aramco. But for these global majors as well, I think they'll be very careful not to increase spending too fast.
Ali, as mentioned there, obviously a lot of the numbers of revenue are not available in the region due to the fact that these are not publicly traded companies other than Aramco. But generally, everybody would be doing good in the region with these revenue levels. We're seeing Oman, its fiscal credit rating improve and so forth, at least through of last year. This year, we've seen Saudi Arabia, the biggest player in the region, start the year with a significant drop in its official selling price for the Arab Light to Asia, $1.50 over the Oman-Dubai average. It maintained that again just today. It published its OSPs, as they're called, official selling price into Asia. How do you read these numbers, these decisions by Saudi Aramco, which of course others in the region will see and sort of take their lead from?
Competition, Sean. I mean, before used to be a different game changer, but now I think with adding more crudes from different places, from America, from Japan, from Brazil, and from Russia, and other places, that you have to compete. This is the world of competition at the moment for the oil. But nevertheless, I think what Saudi Arabia did last month and also continued this month, I think, is just to make sure that they are still having the same level of market share in Asia in particular. Although that, as we all know, that the Saudis they are having some sometimes big shares in the refineries, and they are targeting those refineries to supply them with Saudi crude. But nevertheless, I mean, at the end, these refineries, they're all commercial refineries, and they work according to the whatever we get from the market, cheaper crude, then we will take it. So do we going to continue seeing this? I don't think so. I mean, maybe the market will react and also will stabilize and also will recorrect itself in the coming few months. But it is going to be a difficult time for all of us, not only Saudi Arabia, but the situation, basically, the economy situation in China, it doesn't really support us all.
But yet, it's still $78 a barrel. That is clearly not a bad price from the point of view of where
well,
you might
most of
see
us, Sean,
fiscal.
most of the countries, yes, most of the countries this year, they took a different route. Oman, they have increased their oil price in the budget to $60. So when we talk about 77, 78, or anything between 70 to 80, which is good, but you know, compared to last year and year before that, when it was 50 and 55, then you can say this is a good year or better than last year. But this time, not only Oman, they have increased their oil price in the budget, but also others. You know, they have built their expectation, like what happens last year, where the prices were good. But you know, the situation at the moment is not really the way that we all expected. But we hope that it will still, the minimum is to be within the 70s, between 70 and 80. For how long? I don't know, Sean. Really,
yeah, of course. I mean, Malia, the question, the sort of different factors that are impacting the markets, the oil markets at the moment, obviously, China demand is there. The OPEC cuts, of course, also sort of propping up the price versus weaker demand from China, perhaps. But also the direction of travel with the rate, the monetary policy. We saw when rates and the sort of move up the mountain of tightening in 22, 23, that a lot of the market forecasting on that was wrong. And now we're seeing on the downside that it was also wrong, or certainly unaligned with where reality seems to be unfolding. Where does the consequence of that, and what what more is unaligned or getting it wrong, do you think, from the point of the market in the tightening and the easing cycle?
I think the next 6 to 8 weeks will be very critical for the markets globally. The market is deciding between, the whole world thinks we have a soft landing or no landing, so to speak, where there's a school of thought that we're actually in a recession right now. So the data we're seeing right now has actually been very strong on the US side, but very weak in the rest of the world. The only question is, can the US completely isolate itself and have a manufacturing recovery, or do we see a global recession coming from China? Is that the canary in the coal mine? So if we get a recession, we feel the banking system is very weak in the US, and everything the Fed has done has been to support the banking mandate. We saw Silicon Valley banks. We've seen the US regional banks going through another crisis right now. They may not be contagion, but you're seeing a mark-to-market valuation, hit in all these like commercial properties. So eventually there's going to be a hit to bank lending. When the bank does not lend, the economy suffers. Consumers are completely maxed out on their credit cards. Yes, they're comfortable this year versus 2008, but they're not spending. So the question is there a domino effect? Do we actually start a recession? And that's going to have implications for federal, interest rate policy. So the market right now is assuming that everything.
So are you sort of guiding that the Fed should preempt that by cutting sooner rather than later?
They cannot, because the prices are still too high. Inflation is averaging 3.4 to 3.9%. So we take the view of stagflation. We think growth is slowing down and prices are going to be higher, which means that's the worst time for Fed to save the banking by cutting rates. They're hoping that inflation comes back down and much below, because right now you have shipping container rates that are high. Oil prices are holding up. Prices have not really come down. So if they cut today, your inflation is going to go through a round 2 level of increase. So it's in a very precarious situation. The Fed needs an excuse to cut, and I think that would be probably a banking systemic crisis. So next few weeks, I think the market's going to determine, are we actually growing economically? The oil price, the thing about the oil price is that we are just holding between 70 and 80, and Ali made a very good point. These are not bad prices. If it wasn't for the OPEC cuts, we'd be trading at 45 or 55. So the question is, they're all holding up the prices higher because they've budgeted for $90. We know Saudi Arabia needs higher prices. So the question is, these are not bad prices. What's happening in China and the rest of the world, when commodities in general, they should be a lot lower. So yes, once we go through a recession, the question right now is, will Powell cut interest rates before recession hits? Markets are trading at all-time highs. The Dow, the S&P. If he cuts today, we're going to get a second round of inflation. He cannot avoid.
It would seem very difficult call to. Obviously, they're not going to do it, and they've indicated as such. But absolutely, the idea to cut. My question really, and it remains sort of an unanswerable question on some level, is how the markets got it so wrong with the 6-7 cuts as early as March. And they were just saying that just before Christmas. I mean, maybe they were talking up their own book from the equity benefit of that. I don't know. You never know where to trust these days. Salah, I wanted to get to pick up on your last comments. something I wanted to dig a little deeper into from your perspective. The decision by Saudi Aramco, Saudi Arabia, calling on Saudi Aramco to not proceed with its increase from 12 million barrels a day to 13 million barrels a day. The logic of that, the reasoning, what does it mean for the company itself? What does it mean for the market or its peer group, do you think?
I think it's a prudent decision. I mean, there is very strong non-OPEC supply, non-OPEC plus supply at the moment. And it looks like, as you've alluded to earlier, the OPEC plus cuts that are in place right now will have to be in place in some shape or form for a little while longer. So with that in mind, spending $20 to $25 billion to increase capacity probably wasn't deemed to be the best use of capital. I mean, when you look at current levels, the January numbers just came in last week, and Saudi Arabia is now producing just below 9 million barrels per day. Their current capacity is at 12 million barrels per day. So they're producing way below their capacity on paper right now anyway. So that capital can be redirected into other diversification efforts, which sounds like a solid decision. And I think it's important to remember that this is a reversible decision, right? I mean, and I think a lot of people made the argument that, yeah, maybe this is a signpost for demand, and maybe it is in the near term. But you could easily see a midterm scenario where in 2, 3, 4 years, demand picture is much better. The China outlook is much better. And then they do see, once again, room for them to be producing more as other non-OPEC
I suppose the question will be,
off.
well, that's the big question, isn't it? Does this action get copied by others with, as you mentioned, capital discipline, or would others jump into that space and say, oh, that's 1 million barrels of capacity that isn't coming, get cracking in the Permian Basin and add another 1 million, please. Let's go to the survey question, which is looking at the outlook here. For one thing we mentioned indirectly, but in terms of supply, the idea that Russian crude oil cargoes have been getting to market in multiple different ways. One of them has been the sort of shadow fleet. There was up to 40 Greek VLCC vessels in that market at the first half of last year. And progressively through the second half of last year, that was reduced to 20 as the signals for tightening of sanctions. And then that was even reduced further to 8, just 8 in January last month. So the sanctions, or the threat of sanctions on shippers, on those acting outside of the price cap sanctions, have been given a warning, obviously, by the US, and they're retreating. So the question is, will Russian crude exports, finally be reduced as they've defied gravity for the last 2 years with everything that's going on? But will Russian crude exports be reduced in the first half of this year due to tighter sanctions enforcement? Yes or no? Yes or no? Ali, I wanted to get your thoughts on the OPEC Plus meeting that took place at the end of last year, and the difficulty of that meeting. It would appear, and then we had Angola leave OPEC, and now we have Saudi offering steep discounts into Asia, as we mentioned in our earlier commentary. I'm just wondering your thoughts on the solidarity of OPEC Plus, the challenges that it faces this year, as it looks likely that these cuts will have to be extended through the year. Your thoughts on OPEC Plus harmony?
Well, it's a very good question, and we have seen some difficult time last year, end of last year, during the meetings, and also the harmony was not there last year. The fears are still there. The problems or the issues to be tackled by by OPEC and OPEC Plus members are still there. There is some, different opinions on when it comes to continuous these cuts from different countries. But overall, I think what the results that most of these countries are seeing, which is on the price, which I think this is the thing that they are still keep them together until today. So the EDMOT, goal is to see improvement in the price, and this is what they do now. Based on the situation in the market, I think the price, I agree with you guys that could have been on 40s and 50s if there was no OPEC Plus cuts. So I think they see the benefit, but nevertheless, I mean, every time they meet, I'm sure that there will be this kind of discussions of how long that we are going to continue cutting. But I can see that there is a crack, from the relationships with other countries in last year, and I think maybe this continued until today. But I'm sure that we have a very wise man who is Royal Highness Prince Abdulaziz bin Salman. I think he can bring everybody together again, and it will not really be a big issue out of this misalignments between the countries. Let's hope that these things will continue for another at least 1 or 2 years until we see a better economy, the world economy. Then things could go back to normal. But I think
suppose the challenge will be, like we've seen with Saudi, obviously abandoning its extra 1 million barrel a day capacity increase, because they already are carrying 3 million of idle capacity, which is obviously a big, and the UAE now is increasingly carrying 1 million to 1.5 million of idle capacity. These are very, very expensive projects to develop, as you know.
Yes.
And then to leave them idle is a massive
Absolutely,
challenge.
Absolutely. And that's what I'm saying. I mean, for how long they can continue, going ahead with this with these cuts, especially with the investment that these countries they did on the upstream. So, but they can see the benefit. I mean, the price is between 70 to 80. I think it's a good price.
Maliha, final thoughts on where the demand weakness comes in. You're mentioning Asia, China, the one sort of leg in the stool is wobbly. Europe is clearly wobbly, and America is really the one demand center keeping up this market, combined with supply cuts. But on the demand side, it looks like the US. The likelihood for that to continue through the first half, you're confident that they will continue to be a strong leg in the market?
I think we need to keep an eye on product inventories. The key to the rally here will be distillates, right? China actually has been, we know, been importing a lot of oil to refine and make it into products and send it back out of the market. There's been a lot of arbitrage, and they're playing their margin game. They've been very shrewd about when they're demanding. So we saw the higher numbers in December and January. I think the manufacturing distillate side will see shortage in diesel. So there can be a demand recovery from manufacturing and distillate, but we need to see what happens to the winter. Winter's a lot warmer than normal right now, and I think that's adding to the surplus. So we still have got another 3 or 4 weeks for winter, but if nothing picks up, then we can see a bit of a weak shoulder season. So we're taking a month at a time in terms of how the demand is, but the global economic cycle, we're not very positive from a demand perspective. India is doing pretty well, but China is not, so that's offsetting Russian oil demand. There are a lot of moving factors, and I think it's going to be a very volatile first half based on comparing what's happening with the dollar interest rate policy, right? So there's so many moving factors, Sean, but for right now, I think winter and margins and product inventories are very important, which will probably be supportive for the oil prices over the next few weeks.
And Salah, your final thoughts on one thing we didn't mention, which is a big part of the conversation. Yes, will Russian crude exports be reduced in the first half due to tighter sanctions? We'll post that on social and see if the rest agree. But Salah, the impact on the trading routes, obviously the Red Sea being the big one, the threat to the flow of goods and commodities, the outlook for that to impact companies' earnings, company strategies, Your thoughts on that being a factor in the first quarter to the bottom line, so to speak?
I mean, it's what the kind of turmoil in the Red Sea has caused has been more diversions rather than disruption. So that's why I think we're going to see shipping costs. And with some of the indicators that we watch, we are already seeing freight costs soaring in the last few weeks. So definitely on the shipping cost side, we will see significant impact. But again, in terms of oil, it's not exactly disruption, and arguably this is one of the reasons why we haven't seen quite the uptick in oil prices that some may have expected. Because yes, there's diversions. It takes 10 to 15 days more to get stuff to Europe, for example, but it's not necessarily disruption to oil flows. I mean, if this was the Strait of Hormuz, that's a completely different picture. That's a completely different story. So yeah, exactly. So in terms of shipping costs, yes, we're already seeing a significant uptick, and I think in some companies, first quarter results, this will be quite apparent. In terms of oil price, we've seen limited impacts for that exact reason.
Well, certainly shippers could be making a lot of money this quarter, and insurance companies, amongst others. Where there's losers, there's always winners on the flip side. Well, we'll close it out there, a half hour together, wrapping up. And as we started, Brent crude oil, little changed, with trading at around $78 a barrel. And struggling to find reason to move back above 80 when geopolitical risk, or at least its threat to oil supplies, remains muted. Thank you as always, Ali Al-Riyami. Great to have your insights from Oman, Maliha Bengali from London, and Saleh Yilmaz from Dubai. Really appreciate your time this morning. Have a great day. We'll catch up to you all soon again. Thank you.
Thank you very much. Bye-bye.